Hi, this is Cindy Pressgraves with Cindy's Realty Group by eXp. All right, so let's go ahead and talk about interest rates. Okay, I'm not a lender. I'm actually using this from Andrew Caddy. He did give me permission. So a lot of people have the misconception that interest rates are going to go down and that right now is not the right time to buy. No, this market has completely changed. Completely changed meaning that when you actually have a higher interest rate, you're going to get less of a house. When you have a lower interest rate, you're going to get more of a house. But let's go ahead and talk about interest rates. Interest rates in the twos and threes are fake. That is correct. If someone is offering you twos and threes, you're paying a lot of discount points. I would say shop your rate. I'm not a lender, I'm a realtor. This is going to, I'm going to tell you this. This is going to be a lengthy conversation for you guys, but you know what? I feel that a lot of people are waiting, and you guys are waiting for those fake rates to return. And honestly, it is not going to happen. In the past 3 weeks, we've seen a shift change in interest rates, and it's going to keep on getting higher. But okay, so let's dig really into let's really dig into why these rates really are as fake as a $4 bill with Elon Musk face on it. This is what he's describing. Wait, I have a fixed 2.625 interest rate on my home. How are they fake? You may ask. Well, let me explain. Mortgage rates are currently and have been heavily manipulated since 2009 by the Federal Reserve. The insanely low interest rates, what we saw in 2020 and 2021, people were getting, I saw someone with a 1.79%. Okay, but anyway, that's not the point here. We're just that, a manipulated rate to boost the economy position of the United States. And this is true. That's why they actually did it. This is controlled by the Federal Reserve. Starting in 2009, to end the recession caused by the housing bubble, the Fed became the largest purchaser of the MBS, mortgage-backed securities. So what does this mean? Between February 2009 and 2010, the Fed purchased more than $1 billion, or yes, $1 trillion. There's a lot of zeros in there, in MBS to stabilize the housing market. So this is why it's causing that. Now, this purchasing and some selling has abated and flawed ever since. So, well, fold. I can't talk. Okay, anyways, this is not edited. Whatever. Flowed. So in this case, ever since on a much smaller scale. So when we hit recession at the beginning of the pandemic, a Federal Reserve increased their buying of MBS, which is the mortgage-backed securities. So this is what we're talking about. Keep this in mind. I'm explaining this to you. I'm not a lender. Just contact Andy. I'm going to go ahead and just put this because this is his post. So when we hit recession at the beginning of the pandemic, the Federal Reserve increased their buying of the MBS on a massive scale. Keep in mind, we didn't know what was going to happen during the pandemic. Everybody was like, should I sell? Should I stay? What's going to happen? Everybody was expecting, everything hitting the wall. So in this case, this is known as a quantitative easing. And the last 2 years have been the largest QE, which is the quantitative easing we have seen in history. We have never seen a 2 or 3% in history, in mortgage rate history. And I'm going to tell you, this is between, if you look at the 60s, 70s, 80s, 90s. I think in the 80s, they're like at 13 or 16. Don't quote me on that. I cannot remember how much the interest rates were back then, but people were buying houses back then still. So on March 11, 2020, this is 2020, keep this in mind, the Fed was holding 1.37 trillion in mortgage-backed securities. Today, they hold more than 2.73 trillion. So that's 2.73 trillion worth. So this is why the rates dropped to the unrealistically lows, as we saw, like, hey, you know what? 1.9%, 2%. This was like, whoo, let's party. I'm going to buy $1 million house. Okay, so to the so this is to the unrealistic lows we saw. They were artificially pushed low to boost the housing market, as the housing market makes up 15 to 18% of the gross domestic product. This is also known as GDP. So in this case of the United States, so this is really, really important. 15 to 18%, that's a huge number. And you might be like, well, that's under the 20s. That doesn't really matter. It does mean that a lot. So this boom in the housing essentially brought an end to the recession we were in. But in all reality, it didn't end it at all. What it actually did was kick the can down the road to the next recession. And I'm not saying that we're going a recession, by the way. So please keep this in mind. Just keep on listening, okay? So the rise in interest rates, as we've seen in 2022, has been the fastest increase in rates in 28 years. So 28 years. Look, in the past 3 weeks, we saw a 3 point something to a 5 point something. It's like, oh my gosh, are we seriously? Like this is like, whoa, in a blink of an eye. So in this case, this increase is due to the Fed stopping their purchase of the MBS. Keep that in mind. So the Fed is set to begin a QT, quantitative tightening. So that means where they begin to do the opposite and sell the MBS. Keep in mind, so they're not already, they bought that trillion amount of oh my gosh, in mortgage-backed securities. Now they're selling them. So what is actually happening, because they're selling it, now our interest rates are going up. So keep that in mind. They were keeping control of that. So now in this case, where they begin to do the opposite and sell MBS rather than purchase. So they're selling it. So this is why the interest rates are going up. Some of this may already be baked into, already priced into the market, because they only know it will happen. The rates that we're seeing, but don't be surprised if we see rates tick higher as this period of QT begins. Keep in mind, the quantitative tightening is really, really important. So what happens in 2020 when the pandemic started? Keep in mind, they bought this trillion back mortgage securities. So now they're selling it. So that is actually, they're saying that we're going to be seeing interest rates as low as 7 to 8% by the end of the year. But let me stop you there. Let me continue, and then I'm going to give you some options here. Some of this may be already baked into. So already priced into the market, because they know it will happen. These rates, that's why we're seeing these rates. But don't be surprised if we see it higher. Keep that in mind. Okay, I'm repeating myself, but I want you guys to understand. And please comment below anything you guys have or any questions. Please, please, please. Okay, in summary, we cannot be stuck on the fact that we missed the market lows, because those lows were artificially created to end a recession. Although during a coming recession, the Fed may again purchase MBS, and we can see crazy low interest rates. But let's not forget that a healthy housing market has rates in its 4.5 and 5% range. And that is where we predict things to settle down once the current volatile subsides. So people, you guys have to understand, look, I bought one of my first houses. I bought it at a 5.35%. And my first house was $154,000. Yes, but you guys cannot keep on being focused on the past. You guys have to move forward. This is what we're dealing with. Go ahead and just jump on it, because you know what? It's only going to get higher. And if you have any questions, any concerns, please feel free to comment below. I'm going to tag Andrew, because he doesn't like being called Andy. So this is one of his posts. This is an amazing explanation. I understand. Keep in mind, that it's just going to get it's just going to keep on increasing, and everything's going to keep on increasing too. We're talking about taxes, we're talking about inflation. This is one of the other reasons, but I'm not going to go ahead and get political or anything. This is not a bubble, but it's just a correction in the market. Think about that. So this is Cindy Pressgrace with Cindy's Realty Group. I hope you guys like this, and comment below and share. Have a beautiful day.